one of the things we talked about at the beginning of the first session was it was sort of cloudy with a chance of showers if the weather report was analogous to the M&A market. One of the things that I would have to say today is that the clouds are parting. There's little peaks of sunshine. I wouldn't call it a bright sunny day yet in the capital markets and in the M&A world, but we are seeing peaks of sunshine, and I think part of that is being created by the little bit of hope that we've got around economic stability, that the markets may have truly hit bottom and are working their way up slowly but surely. With stability, we pave the way for clarity, and of course with clarity comes real deal making, or at least as much clarity as you're going to get in this market. But Joel, sounds like what you guys are seeing are consistent with the outlook for late 2011, 2012 that I'm seeing, and then I'll cover some trends on this slide that's showing up in a second.
Mm-hmm. Yeah, it's amazingly how consistent our aggregate numbers map the Dow index.
Yeah.
On deal room usage, and it's a lot. It obviously reflects confidence in whether it's the stock market or the M&A market.
Absolutely. And when it comes to buyers, and we're about to turn to some trends specific to buyers for 2012, I almost feel like I want to get on a megaphone to the capital markets and say, attention Kmart shoppers, attention Kmart shoppers, we have bargains in aisles 1 through 27. It is in my mind still very much a buyer's market. EBITDA multiples and valuations are relatively low to medium. Very few industry segments are they on the high side. We have, as the slide says in bullet 3, somewhere between 2.5 and 2.7 trillion in cash. I mean, think about that. That's even with the numbers that are thrown around the Beltway from time to time in the government, that's a staggering amount of cash. Apple yesterday was announced that they're sitting on $82 billion alone. $82 billion. I mean, at some point that capital has to be put into the marketplace, either in classic sort of buy versus build analysis, which we'll talk about for a few minutes today. It either needs to be put to work for organic innovation or put to work through acquisition. And I think that as we see that cash starting to start moving into the marketplace, as CFOs and CEOs and senior vice presidents of corporate development start seeing some clarity in the marketplace, I think we're all going to be very, very busy. So that's my sun coming out through the clouds forecast, and really does pick up on this slide that's now showing in front of you all. I would be selective. It's still very much a buyer's market. The competition for deals is not as intense. Even in your auction and limited auction transactions, I think you're seeing a little less competition, valuations being a little bit more reasonable. One comes to today will be to be strategic, to acquire based on specific acquisition objectives and plans, and we're going to talk a little bit in today's session about how to prepare an acquisition plan that can be effective. And one of the key points that you'll hear me talking about both today as well as in the December session is really being inquisitive, looking for hidden strategic values, looking for hidden intangible assets that can be harvested. I'm a very, very strong believer that we have literally trillions of dollars in unharvested intangible assets, which is the point of this new book that just came out. Actually, Elizabeth, today is the official pub date of the book, and so check it out on Amazon if you're listening in and have an interest in this topic. So be selective, be strategic, be efficient, and be inquisitive would be among the trends I see for 2012. Next page. A few more B's. Be persistent, prepared, and be a visionary. On the persistent side is really a sneak preview of the topic we'll be covering in session number 3, which is the due diligence trends are getting wider and deeper. particularly in an era of financial accounting problems and internal control problems and post-Sarbanes-Oxley and soon to be post-Dodd-Frank once they start writing the regulations to go with Dodd-Frank, which they're running behind on. But, you really need to be persistent. It's a, deals right now are a marathon, not a sprint. And as a marathon, you need to pace yourself and you need to make sure that you are really digging at due diligence both deep and wide. As I mentioned on the last webinar, while the services provided by Firmex in hosting data rooms are hypercritical and can be incredibly efficient, they're not a crutch and should never be a crutch. I'm sure Joel would agree, for the kind of face-to-face due diligence that needs to augment the data room experience. And so it's really got to be both. I get worried sometimes, I'll talk about this more on the next session, that some of our younger generation folks who have grown up doing everything on their PDA and portable device don't understand that due diligence is both an online experience and an offline experience. But we'll come back to that in the third session. Being prepared, revisiting financial models, investment theses, testing and retesting them, making sure that you've got a handle on your cost of capital and your leverage ratios, making sure that you have a big handle, and we're going to talk about this more in session 4, in the post-integration challenges. We're seeing some deals that were done last year with a little bit of haste, and now the companies are running into post-closing integration challenges where IT conversion costs, employee costs, operational issues, distribution channel issues are costing them more on a post-closing basis than they had anticipated, thereby throwing off the original investment thesis. And as we'll see in a few slides, that is not unfortunately, is not a one-off or unique experience. More and more companies seem to be misjudging their total acquisition costs, and that's diluting shareholder value, diluting stock price, not the kind of M&A strategy that people are anxious to implement. And that's where being a visionary, thinking through these integration challenges and post-closing hurdles is so critical. Next slide.